speaker, Michael Neiman. Michael's a CPA and has significant experience in this field. And he's going to talk to us about post-sale tax planning in 21 and 22 and beyond pre-sale tax planning. Michael, thanks for being here. Welcome and take it away.
Well, thank you, Kevin. I really appreciate it. And there is a chat bar. If anyone has questions along the way, we'll try to answer them. We're going to try to be short to the point. There's some stuff, we're gonna go through a lot, so we're not gonna get into real deep detail. So please don't hesitate to ask questions. We'll try to answer them. And if we can't answer them, we'll follow up with you afterwards. So all that being said, thanks for being here. It's been a busy year. As I'm sure Kevin could tell you, the M&A world has been on fire this year, just sort of the perfect storm with low interest rates, pending tax law changes, pent up COVID demand. All these things have helped, I'm sure, drive Kevin and other people in the M&A world's business and have helped us have a need to get involved from a tax planning point of view. So with that being said, let's see if I can get this to work. Oh, yeah, let me go back up one slide. So before we jump into the changes, these are the things, and I haven't seen in the last 24 hours if this has changed. Everything's in limbo. But right now, the things that affect this market, and there's a lot of other pending tax law changes and other stuff, the thing that affects this market, at first blush, if you read where the most recent proposals, which look like a high probability of getting passed, that there be no, the big print is no tax rate changes for individuals or corporations. And that is a big surprise, pleasant surprise for our clients. And at first that sounds really good. You got to look at the fine print and look at the hidden rate changes, excuse me. And when you look at that, when you're talking about this isn't going to apply to most of the business owners we deal with on a yearly basis. But if you're going out and selling your business, this can apply, or your client that's selling their business. There's a surcharge at $10 million of adjusted gross income. And if you think about that, you say $10 million, how many of my clients have that amount of income every year? Well, they don't, but if you're, a lot of them don't, but then if you're selling your business, you might get to a $10 million threshold. Or if you get to $25 million, there's an 8% surcharge, another 3%. On top of that, right now, the federal capital gain rate right now is 20%. And most of the gain, most of the deals we're dealing with, that's the vast majority, if not all of it. There might be some recapture, there might be some ordinary income in certain types of transactions. But all that being said, what the tax that does not apply is the Medicare surcharge, the NIT tax does not apply right now to a sale of a business asset or business. And so if you have it's a 20% rate. If you sell your Tesla stock, it's subject to that, the 3.8% add-on. But if you sell your business, it's only a 20%. Well, they're going to make that apply to business income. So what does that mean? Our current rate right now is 20%. You tack on all the way up, assuming you get to a $25 million gain in a sale, and the 3.8% surcharge, you're up to 31.8%. So this no tax rate change really is up to a 59% tax rate in change for large transactions. So that's the part that people I don't think get focused on. So what can we still do? I know, and I'm sure Kevin probably has a couple deals that are going down the wire. Is there anything we can still do before the end of the year? And this works whether it's next year or this year. But what every client says when you first talk to them, obviously we all want to get together with our clients well before a transaction happens. Unfortunately, that's not reality. And what do I mean by not being reality? We get a call, hey, I just got an LOI, we got the letter of intent, we're closing in 3 or 4 weeks. What can we do? And a lot of the alternatives go away, but there still are things that can be done. And the most common, you hate to use the word, but blocker for income tax purposes on planning at the last minute is using a charitable vehicle. And you could donate your business, you could donate part of your business, you can donate appreciated stock, as people do all the time, to charity, right before year end, right before it's sold. Well, if you take your business when there's still some vulnerability of the deal falling through, in other words, you got a letter of intent, but you're still in due diligence, you can do charitable planning. So what this idea here says is, what if we had a $25 million business and we stick it into a charitable trust? And that charitable trust is going to give us back for the client, client spouse, potentially for future generations, a 4%, excuse me, annual distribution, about $1 million. It's fixed at $1 million. We're going to get $1 million back a year out of this entity. That money gets to be, after we sell the business, no tax is caused on this. The charitable vehicle blocks the tax, and that 4% distribution is going to come back to us every year. All the appreciation over that $1 million a year is going to appreciate to the family, to a trust, to your kids directly, to your spouse if you want, or to yourself. What we've done is we've sold the business with no taxable gain. We have put in a lifetime stream of income for all the income and all the appreciation. And the charity someday, at the death of the last person we name, will get the money. We'll get the $25 million. So we have clients doing this. I have a 90-year-old that just did this. And so you can say a 90-year-old doesn't have a long life expectancy. Obviously, it's relatively short, in the grand scheme of things. But then he named his 3 children. And then after his 3 children, his 7 grandchildren. And after the 7 grandchildren, all the way down to 1 great grandchild that's 1 year old. So we now have created an 80-year stream, potentially longer, that the family will get, in this example, $1 million a year. And then after that 80 years, the charity is going to get $25 million. And so when you look at that, when you look out, for generations, it gets to be pretty profound. So we have an example in here that, forget what all the numbers are. This is on a $25 million example. The orange line is, hey, what if I sold and I had roughly $20 million after taxes? What would happen every year if I was spending that $1 million a year? So I'm reinvesting it, paying taxes. We did this under Missouri taxes. We can run assumptions for everyone anywhere in the country. Very easy. It'll be a little bit better. You'd have a little longer duration on that orange line if you're in Florida. It'd be a lot worse if you're in California or New York. The blue line, the dotted blue line, says, hey, here's how much money I have in my bank account. Well, I put all the money in this charitable vehicle. Most of our clients don't put all of it into here. They'll sell some outright. The only reason it's not at zero on day one is I got a charitable benefit. In this example, we're just doing it for the life of the client. I believe the client in this example was 50 years old or thereabouts, roughly a 50% charitable deduction. So you see that money grow over time. And so my bank account's getting bigger and bigger. I'm taking out $1 million a year and consuming it. But after, it's really easy to look and say, gosh, year 15 is a break even. That's really not true. If you look at the solid blue line, that's future distributions. And in that distribution there is going to come out down the road. We're going to get that $1 million. It's $1 million. It's a fixed amount. It's a preferred interest. And a question that already popped up is, can I structure that distribution every year to be tax-free? And the answer is possibly. The way it works on these types of charitable vehicles is the distribution coming out is going to be whatever the taxation is of the income inside the charitable trust. And if the charitable trust is invested in taxable investments, the distributions will be taxable. If it's invested in tax-free distributions, which is a little beyond the scope of this conversation, but things like life insurance, other types of tax wrappers that can give us a tax efficient distribution schedule, then that money's coming out. I pay no tax on the front end. I'm getting an annual distribution that's income tax free, and I'm getting all the growth down the road, also income tax free. So that's one thing to think about. So anyway, so you see this. So our client in this situation, when they get out to their life expectancy, they had $7 million out of the $25 million left. They pay $3 million of estate taxes. Roughly $4 million goes on to the next generation. In our planning, at their death, they end up sending out to the next generation $153 million minus the $30 million going out to the charity. So we've turned into, and the total amount actually here going to G2 is $158 million. And $158 million versus $4 million. We can run assumptions. We're making a lot of assumptions here. This is a tax-free scenario. We have 4,000% of the amount of money if we did no planning. So obviously, if we block all the taxes on the front end, block all the taxes going forward, we have a pretty profound impact, and we get a charitable deduction, which is roughly equal to the age of the last annuitant. So if I'm 56 years old, if I did this on myself, I'm getting between a 50 and a 55% charitable deduction. If I do it on a 30-year-old, you're going to get closer to 30 to 35% charitable deduction. Do it on a 1-year-old, you're still getting a 15% charitable deduction. So we can go out for an 80-year distribution scheme and still have a huge charitable deduction. And by the way, that 4% is fixed at 4%, as I said before. So where does this work? Obviously, what I've been talking about here is you're about to sell your business. Hey, Kevin's done a great job. He's got it teed up. We're about to sell our business for $10 million, $50 million, $200 million. The size really is irrelevant. And then we can go into the structure and block the tax. Also highly appreciated property. As I mentioned before, right now you have an extra 3.8% surcharge if it's not business property. So if you're selling your Tesla stock right now, you've got that issue. Or we're working right now on some Bitcoin and other type of cryptocurrency. What if you have a large concentrated position? We've been talking to a lot of the largest investment firms in the country about, hey, these clients, whether it's Walmart stock, whether you pick it, what am I concentrated in? And the family over time wants some diversification, but they don't want to pay the tax to get out. And by the way, they want the diversification, but these large families tend to be very philanthropic. So if you're going to give money, but it's going to be at the death of whichever family. So you could have a stream for the rest of your life and your kid's lifetime and still have a lot of money going out to charity. And then the final one here is sale of real estate. Actually sell of real estate, which falls in the business thing. And then there's a sneaky one on here. Sorry, I missed this. ESOPs already have a tax-free treatment. You can go sell your business. If you're a C corporation, go sell your business to an ESOP, to your trust, and not pay tax. And that is a great answer, but you have to go into what's called QRP, qualified replacement property, which is very limiting. What do I mean by very limiting? You have to invest in a U.S. security. You can't go into funds. You can't go into an S&P fund. It's about 420 to 500 S&P stocks you can invest in. And it's stagnant because you're going to have zero basis in that stock, or very low basis, historical basis. So you can't sell it. When Tesla gets to high, you can't sell it. When GE starts going in the tank, you can't sell it, or you're going to have tax consequences. So going into this kind of vehicle will alleviate the tax concern, and you can be in a constantly evolving, diversified portfolio, invested in all kinds of things. And if you put the right wrapper inside of it, potentially into private equity, funds, and so on. Don't worry, the rest of the slides, we're not going to spend quite as much time, but hopefully that this is helpful. And I went up one too many. Okay, let's see if I can do this without messing up. This slide, we won't spend a lot of time on it, but what if you have an entity, a corporate entity, either an S Corp or C Corp, that you're going to sell the assets inside of it? The prior structure I talked about doesn't work with that. There's still another charitable trust here, a charitable remainder trust that we can do inside of an S corporation. It's the most common. And it can have still staggering effects. There's going to be some taxation along the way on those distributions, but we have a way of combining it with the family limited partnership and getting 40 to 50% of the proceeds out over a relatively short period of time, income tax free. And then the charitable remainder trust really makes it a deferred taxable event, and it has its benefits of that. And long story short, we're saving 90+% of the tax at some point. Plus, we're giving some money to charity. Both these ideas are last minute ideas we can do and have a very philanthropic edge. Both of them, whatever we promise the charity, they're getting. We're not telling the charity they're going to get $100 and they get $5. We say that first idea, they're going to get the 25 million, they're getting 25 million. In a charitable remainder trust, they're going to get what's left in this thing based on whatever our charitable deduction is on the front end. Potential solutions for situations for this: assets inside, sales inside of C Corp, S Corps, and so on. What do you do? So before we go on to the future planning, which the first one was a little bit of future planning, but what do I do if I have a business? What if I have a business and I have some key employees? And I can tell you about this idea that I did here. I first did with employees. I've been doing this and I've had it audited. People always ask that question. First did it with a client about 15 or 18 years ago. Client was selling business, did some of the stuff, did that CRT idea I just mentioned a few minutes ago. But he had two key employees. He said, if I ever sell the business, I'm giving you each $1 million. And so what he did instead was he said, if I gave you $1 million outright, you're going to pay tax and you're going to be lucky to have, $550,000 after taxes. But by doing it through a split dollar arrangement, a discounted split dollar arrangement, they were end up to really get 80 to 90% of the money after taxes. It's a little bit beyond the scope of getting really deep into here, but what you're basically doing is lending them money. And at the end of the day, at some point, that loan is transferred to them and the valuation of that loan is greatly discount it under the discounting rules that apply to split dollars. So anyway, long story short, it's something that you can do with employees. And get this going here. Let's see. I lose my screen controls. Oh, when would I use this? A bonus on the sale of the business, long-term employees. I use this with one client that said, hey, we want to keep Tony around. Over 50% of the sales are related to this. So they said, hey, Tony, we're going to put all this money in. We're going to give you some life insurance along the way. And if you're here, you're 50 today, but if you're here at 65, we're going to forgive that note. And so, instead of having $500,000 taxable income when he retires, or owing it back to you, by the way, is what technically happens. You say, hey, Tony, thank you for sticking around. Here is your retirement bonus. And by the way, instead of paying tax on $500,000, you're paying tax on maybe $50,000 to $100,000. It's also a way, hey, I got a C corporation. I hate paying dividend tax, even though, dividends are taxed at the capital gain rate. I have $10, $20 million trapped, $2 million, doesn't matter what the size is, trapped inside my C corporation, or I have excess money inside my S corporation or LLC. I can't get out. Well, you could structure this, if you have a C corporation, to potentially, if you have an insurable reason of, on your executives, your owners, that at some point when they retire, they sell the business, they get out that excess cash out at huge discounts. All right. And somebody asked the question. I'll go ahead and answer a couple of questions here. First of all, when does a surcharge start? The surcharge, my understanding, and I'm not the smartest tax guy on this call, meaning there's 100 plus attendees, that I think the answer is it's all 2022. All these proposed rates are 2022 and beyond. And so that's when the surcharge would apply. There is going to be a recording of this, I believe, and at least the slides will be available afterwards, but reach out to us and we hopefully will be able to get you a copy of the recording. And then on the stream of income, on that first idea, which I'd go back to, or I'll mess up the slides. But if we said, hey, I'm going to get that $1 million a year, if I'm 56 years old and I said, I'm going to do it for my lifetime, I'm going to get a 50+% charitable deduction. If I say after my lifetime, it'll go on to my kids and or grandkids. I don't have any grandkids yet. My youngest child's 10. I know I'm an old dad, but at the end of the day, so if I did it on all my children to get it after I got it, my wife got it, we'd get somewhere around an 18%, 20% charitable deduction. And so what it's done is it's lowered the charitable deduction from 50% to 10 or 12%. I'm getting a lower charitable deduction, but I'm keeping the money going on another potentially 40 years by having that income tax-free use of that money in that charitable vehicle. The charity's getting the same amount, whether they're getting it in 10 years after the first generation dies, or 80 years after the last generation dies. If you do that, it's all going to affect the charitable deduction. So our clients tend to go long-term. If you've already blocked the sale, the tax on the sale, why won't you go really long-term? It's hard to use the charitable deduction. We have some ways to enhance the use of the charitable deduction as well. So what about, hey, you know what? Life's not over on December 31st. Kevin isn't closing up business. Kevin's going to actually continue to work and do a few things, hopefully sell a few more businesses in 2022. We still have a very vibrant economy, and we all know things are cyclical, but God bless, let's keep it going. So what if we're going to have a company that's just now starting to think about going out there, and they're just talking to Kevin and say, Kevin, hey, the next 6 months to 36 months, I want to sell my business. Well, an estate planning idea that's been done for decades. I'm not here to tell you this, the first person that's ever told you this or ever thought of this is, hey, before I sell Smith Company, I'm going to go write a stock option on my business. So let's make up a fact pattern that today, if Kevin came in and said, I'm going to sell it for 100, but today you got to clean it up. You got the kids on the payroll. You got bad accounting. You need a good, real CFO. Sorry for the CFOs on the call. And all these great things. You need to clean up what's going on here. And then we think we can sell for around 100. But today, if I had to do a fire sale, you're going to get 50. Well, then we do our estate planning magic and we discount things down, non-voting shares, all that stuff so far not changing in the tax law. And let's say it's worth the low 30s. Well, let's write a stock option at 35. So we put the stock option into a trust. You sell the business after Kevin does his magic, and you sell it 6 months, 18 months from now, whenever it is, for 100, where does that money go? That money goes inside, who owns it? The 35 goes back to mom and dad. They're selling the business, but and they own the stock, but they granted an option on it. So the option holder, which is now the trust, is going to get everything over that. So there are other estate planning ideas that can transfer the same equity, but we're moving that 65 of equity here to the trust in this situation. So why am I talking about this on an income tax planning? There is a way, if we combine that with another tax wrapper, that we take that option before it appreciates and we stick it into another vehicle that will make those income tax proceeds, that those $65 in my example proceeds, tax-free. So now what have I done? I've done a big wealth shift, and I blocked 2/3 of, in my example, going from 35 up to 100. I've blocked 2/3 of the taxation roughly in that situation. So that is a really powerful thing. I'd love to talk more about it. We have short time here. Where are I to use this? Startups. If you're just starting out and you've got the next idea that's about to take off, or your point is, why not write an option on it? Think about the options between two different family members. There's no lost money. You're not selling an option to me or anyone else. You're not buying an annuity. You're not buying any type of product that has a big fixed cost in it. You're just moving the upside. The worst is if there's a payment back out of a existing trust, it's a little bit of reverse estate planning. The best is we've done a huge wealth shift and potentially a huge income tax shift. Rolled over equity. As Kevin could tell you better than I do, every deal, not every deal, but the majority of deals he does, the buyer, the private equity wants to keep the owners around. So they turn this thing into, so I sell my business for 100, but I kept 20% of it. Well, I kept that hopefully tax-free, right? And now we're hoping the private equity comes in, they leverage it up, they bring in all their smart people to help take our business to another level. We're hoping that round 2, when Kevin sells this in 2 or 3 years for us again, is going to be bigger than round 1. Can I take that upside and write an option on it? And the answer is yes. And related to that, any business that's going to sell over the next 3 to 5 years, if it ends up going out farther, we write a new option at that time, or pre-IPO stock. Hey, I have a client right now that's a very successful doctor, and he just got, and one of his buddies talked him into putting $500,000 into a stock. I wish he would have called me first, because that stock is about to go public. They think his stock is going to go up 80 times. It's going to be worth $40 million. And so he could write an option on that if he did it early enough. And if it's too late, then we go back and we do the charitable trust that we talked about at the beginning. But IPOs obviously have a lot, even if it's 2 days before the IPO, if you're not in a blockout period, obviously, in which he wouldn't be, because maybe he is. I'm not an IPO expert, but if it's at the right time, you do it before an IPO, IPOs are still going to probably take the value up double or triple, maybe not 80 times. What about post sale? So those are ideas that, hey, we're thinking forward. What can we do for things that are going to happen 6 months, 9 months, a year or 2 from now? Well, what if I've already sold? Okay. So you guys, the worst question I ever get, and I cringe whenever anyone calls me and says this, but the reality is there are things we can do afterwards. What if I've sold my company already? I already sold it. Kevin already did his magic. I already got the $100 million, $90 million capital gain, or whatever the number is. And now what do I do? Well, you still can do things. And the most common thing that people do after they've sold their business for a lot of money is give money to charity, which is obvious. Hey, we've never felt wealthy. Now we are wealthy. Now we're going to take care of our church, our university, or whatever your favorite cause is, or just put a whole bunch of money into a donor advised fund for future distributions out to your favorite charities. So what if we did the same idea we did at the beginning, but instead of putting my business in there, I put cash in there? And I apologize. I just realized this slide is wrong. It says business interest. So in this, the words at the bottom are correct, but he and she put $25 million of cash into a charitable entity. They're going to get that same $1 million lifetime income stream for their lifetime, their kids' lifetime, and so on. In this situation, you might want to just do it for your lifetime. Why is that? Because it's going to drive up the charitable deduction. So if I did this for my lifetime, I'm getting a 50+% charitable deduction. So I put in 25, I sell my business for 50 or 100. I put 25 million in this vehicle. I'm going to get a charitable deduction of 12 or 13 million dollars. And for the rest of my lifetime and my wife's lifetime, we're going to get $1 million of income out of it. Structure right, income tax free. All the appreciation over those years is going to go to my family trust, also income tax free. So that is what we can do. This example, if you remember the earlier example, the orange line went down to 0. Why doesn't it go down to 0 here? The blue line is exactly the same as it was before. We had the exact same amount of money. Well, I guess actually the other one we went out for 2 generations. This one's only going out for 1 generation, but the trajectory is the same. It's substantially up. The orange line doesn't look quite as bad. Why is that? Because we're not paying tax on this. This is cash we're using after tax money. We're not talking about what your gains were on your sale. We're saying, hey, we know we're going to have a big gain. What can we do now that we have a big gain to come up with an ending charitable deduction? So we leverage off our charitable intent here, and we create a lifetime income stream for ourselves and potential. If you want to go out for your kids as well, go out for your kids, a lower charitable deduction. But in this situation, it could be very, very powerful to offset some of those taxes that you're going to have at the sale of business. And if you know how charitable deductions work, the charitable deduction first will offset your income related to your highest rate interest. So if you sold your business on December 31st and did this simultaneous, all the K1 income you would have had for the year, you get offset that first, which is going to be 37% ordinary rate right now versus 20% capital gain rate. Once you eat through that, then you'll get down to your capital gain income. Where does this idea work? Let's see if I can get the slide to work. Oh, here we go. If you have a large taxable event this year, makes sense. Or you just regularly have a lot of taxable income, and then the last one's very philanthropic. If you say, hey, I'm making 10, 20, $30 million a year, go do this idea, and you can get what we're talking about here. Since it's cash, we're not moving business interests around. This could be implemented in 1 to 2 weeks. There is a charitable expert on this call right now that has helped us do the actual part of the charity part in literally 1 or 2 days. So this stuff can be done quickly. Please don't call us on December 26th. But if somebody made the decision and their advisors were on board by early December, it's something that can still be done this year to offset that. So that's the big picture. Kevin, this was not as interactive as most of our conversations, but what didn't I answer? Any questions that you have?
No, I thought this is very good. I thought it was best with the amount of information you had to let you run and folks ask their questions as you go. There was a question about, does this work on $5 million deals in less?
So good question. And by the way, I was looking at one screen and now I have the Q&A, so I wasn't looking at the other screen. So I do have the answer to these questions now. So on a $5 million deal, these ideas work. Size is important. And a related question to that is, can I do this with some or, just part of my business? If somebody, one of the first questions we ask, if somebody's going to sell the business for 100, and I use 100, not to imply that all our deals are $100 million, just 100 is an easy number. You can multiply it, divide it, whatever. And so if somebody says, I'm going to sell for 100, well, our next question, I'll give you a real example. We had a case out in Colorado, a guy was selling his business for 25 million. His CBD business, and he's going to move to the Florida Keys and live live a nice life. He's going to buy a boat, a yacht, a house, and in that order, by the way, and a boat, a dock, a house. And and so we're talking to him. We're like, well, okay, this isn't going to give you a lot of stream. It's only going to give you that 4%. It's going to give you $1 million a year. Well, how much do you need right now? So we only put in 17 or $18 million of the business. Why was that? The other part, he'd sell, a lot of that would be offset by the charitable deduction. And then he'd have that cash to fund his consumption. We're not here to limit people's consumption, and then as the assets appreciate and your common interest grows, if something grows at 10% in year one on a $25 million deal, that's $2.5 million of growth. $1 million gets distributed back to you. Where's the other $1.5 million? It's all going to the common interest. So over time, you can pull out even more money than the $1 million. But up front, there's consumption needs. So how much can I do? I can do that. When you get into smaller transactions, meaning, get down to $2, $3, $4 million, we find the consumption needs gets to be really high. And what do I mean by that? Is if I'm selling my business for $2 million, that might be great. That's awesome. but it's a different amount percentage going into buying my house or paying off my mortgage or whatever that consumption need is versus if somebody's selling for 200 million. You know, the needs are going to be a much higher percentage on somebody on a smaller transaction. So the smaller ones get to be a little challenging. Some of the things that go into, if we're going to put an income tax deal in there, some of the things may need have a $5 million minimum, but there's usually workarounds, there's ways to get there. But those are all kinds of things we can work through. Another question out there was about donor advised funds. Donor advised funds, everything we talked about here when it comes to the charitable part includes public charities, charitable remainder trust. You might be able to do something different, but it affects your charitable deduction. So a public charity, yes, donor advised funds work, and that is ultimately where the money's going to go. So anyway, and the guy that asked the $5 million question, I know very well. So we can talk afterwards if there's something that we can help with. And these are, by the way, we went through a few ideas today. There's 20 or 30 ideas. The goal is to get thinking earlier is better, and to think about the kind of stuff that you can do on that. So,
Excellent.
Kevin, any other questions?
No,
what do you
Michael,
feel
that
about
was
the market?
great. I think our time is up. This has been very, very, very good participation from the audience. If you have questions, reach out to me, reach out to Michael. If you would like a copy of the slides, I think we're going to be sending them to you anyway. But if you'd like additional information, let us know. Thank you for participating. Thanks, Michael.
Thank you. Bye-bye.
Bye-bye.